Hey, what's up, everyone? Welcome to another Tax Tip Tuesday where we discuss real estate related tax advice. And this week's episode is going to be on the topic of depreciation recapture, which applies almost exclusively to real estate investors. If you're just owning your primary residence, the only time this would apply to you is if you had a home office and you were depreciating your house as a part of that. But for any other case, it's just real estate investors. And if you remember from a few episodes ago when we talked about cost segregation, depreciation is a huge part of owning rental investments or any type of real estate investments. Basically, you just take a portion of the property that you're writing off every single year, and you get to take that as an expense year over year over year. And it's great, one of the best tax advantages of owning real estate. But there is a downside to it, and that downside is called depreciation recapture. All right, so let's dig in here. So when you have all this tax savings from depreciation year after year, it's great in the moment it's happening. But depreciation recapture simply means you're repaying that, essentially what you saved at the time you sell the property. All right. And to figure this out, you're just going to take your accumulated depreciation, which is just the total depreciation taken while owning the property. All right. And it's going to be taxed at either your marginal tax rate, which is just the rate that your next dollar is taxed at, or 25%, whichever one is lower. Okay, so the max you're going to pay is 25%. If your marginal rate is lower, you're going to pay it at that rate. And we'll have a whole video on marginal versus effective tax rates because it's a pretty interesting topic and a lot of people get it mixed up. All right, but just know now that 25% is the max you will pay on this depreciation recapture tax. All right, and the final thing to note before we look at specifics here, taking depreciation is not an option. The IRS requires you to take it. Right, so you might be thinking, oh, I don't get to take the losses anyways. I don't want to pay this depreciation recapture. I'm just going to not take depreciation. Not an option. All right, the IRS will let you technically. They won't force you to take that tax advantage, but they are going to force you to pay depreciation recapture tax as if you did take it. So even if you never took it, never took any tax advantage from the depreciation, you are going to pay that depreciation recapture tax when you sell the property. All right, so worst case scenario, if you can't take it in that year, it's going to keep carrying forward, which will help you, as we'll discuss in a minute. So always take the depreciation. It is a requirement, and you will pay the price when you go to sell if you don't. All right, so let's look at a specific example here. Let's say that you purchased a rental property for $500,000 in 2013. All right, and if you remember from when we discussed this a few episodes ago, you always have to break it down by land and building improvements. Right, the land portion is not depreciable; the rest is. So let's just say that the land value was $100,000, and let's say that the rest, the building and the improvements, were $400,000. Right, let's say you sold the property at the end of 2023, so essentially you owned it for 10 years. And let's say that the total accumulated depreciation was $145,455. Right? So accumulated depreciation is what you're going to pay that depreciation recapture tax on. All right, so let's just assume that you're going to do the 25%. Again, if your marginal rate's lower, you'd pay less, but let's just, for this example, let's use 25%. You take that total accumulated depreciation, the $145,455, you're going to multiply it by that 25%, and you are going to pay taxes just on that depreciation of $36,364 when you sell that property after 10 years. Right? And again, this is not capital gains. You will owe capital gains on top of that if you sell it for a profit. This is just the depreciation recapture tax, and it's going to be $36,000 in this scenario. So if you own a fairly expensive property and you own it a decent amount of years, this is going to add up very quickly. So you need to pay attention to this. You need to plan for this and know that it is coming. All right, so let's talk about, can you avoid it? And if so, how do you avoid it? So there are a few ways you can either avoid it or defer it. The first one is to lose money on the sale of the property. Right? The losses on that sale will offset the depreciation recapture. So let's say you bought that property for $500,000. Let's just say you never did anything to it. Your total basis was $500,000. Let's say you sold it for $350,000. So you have a loss of $150,000. That can be used to offset the $145,000 of accumulated depreciation. So in that scenario, you would not pay any depreciation recapture tax. It would all be wiped out from your loss. Now, I've never seen a scenario where someone lost $150,000 on real estate. All right, in this market, it's very hard to lose money on a sale in general, but it does happen. And if it does, those losses would offset any depreciation recapture. Second way to avoid this, have non-deductible losses from previous years that carried over. All right, so a minute ago I talked about how you always take that depreciation, and if you can't use it in the current year, it keeps carrying forward until you can. Well, if you are never able to take it on your tax return, when you sell the property, all those losses are unlocked, and they can be used to offset both capital gains and depreciation recapture. So if you had $150,000 of losses over those 10 years that you were never able to use, when you sell the property, that would offset your capital gains and your depreciation recapture. All right, the final way, and maybe the most powerful way, not to avoid it, but to defer the depreciation recapture tax, is called a 1031 exchange. And all this means is when you sell the property, you're using that money to immediately invest in a new investment property. Right? You can't go and buy your own personal residence with the money. It has to be an investment property. It's called a like-kind exchange, meaning it's like the investment that you previously sold. All right? But if you do this, though, you don't pay any capital gains or depreciation recapture tax at the time of sale. However, you're not avoiding it, you're deferring it. So if you were to do a 1031 exchange, buy a new property, then sold that property 5 years later without a 1031 exchange, you would then owe taxes on the previous one plus all the new taxes on the one you bought. So you're deferring it, you're not avoiding it. All right, but there's a little bit of a loop here that people tend to use, especially people that can afford to do this. If you keep that property that you did a 1031 exchange into, or just continuously do more 1031 exchanges, and you never sell one without a 1031 exchange until you die, all right, whoever inherits that will have the stepped up basis, and you will never pay depreciation recapture or capital gains on all that depreciation and all those gains that you had. So if you can afford to keep it forever and never sell it, you can avoid it permanently. At least your heirs can. You won't ever get the benefit of that, but people after you will. So those are the three ways. Lose money on the sale, have non-deductible losses that you've never gotten to use and that are unlocked when you sell, or a 1031 exchange. And we will have an entire episode on 1031 exchanges. It's one of the most powerful parts of real estate investing, one of the things people get most excited about. So stay tuned for a future episode on that. All right, so final conclusion. Depreciation is one of the single greatest advantages of owning real estate, tax advantages of owning real estate, right? It can, especially a good sized property, can wipe out a large part of your tax bill, especially if you qualify for real estate professional. But you have to know that depreciation capture retax is coming when you sell, unless you do a 1031 exchange. So plan accordingly, know that tax is coming, know what options you have to reduce or defer that tax, and you'll know what to do. All right, if you like this episode, if you found value in this episode, be sure to like and subscribe, watch a future episode, and we will see you next week.